My name is Andy. I have been with GIZ project since September 2017. My background, I worked in politics for several years in Berlin and Brussels. I'm a trained banking professional and I studied business and law. So who does what here today? Paul is our GIZ consultant. Together with Samantha, he will show us today how we digitalize the SME business of Yoma Bank. With our pilot bank approach, we are improving access to finance for SMEs in Myanmar. As I said, I have been working for the GIZ Banking and Financial Sector project since February 2017, together with the best possible support of Chita Moore, my local colleague who joined the project in March 2017. Before we jump into the topic, let's focus a second on the most important precondition of digital finance: the availability and usage of mobile services in Myanmar. The numbers are quite impressive. 105% SIM card market penetration are leading to a potential 105% mobile broadband penetration. I always find it funny, why should people have more than one SIM card? But even I ended up with 3 SIM cards for friends and family here in Myanmar. But let's focus on the numbers. 80% of the population are having a smartphone and 50% of the population can be seen as a unique mobile subscriber. What does it mean for us? We are having a quite good uptake of mobile services in Myanmar, and we are facing still a good growth potential. And both facts are really important preconditions for digital financial services in Myanmar. And also for us, as Chia said, what is the perspective for development cooperation, especially for financial sector development projects? Only 30% of the population have access to formal financial services, and 78% of internet users have a poor digital literacy. I think it's fair to say that there's something to do for us also in the future. But back to the topic, digital SME finance in Myanmar. A credit application has many hurdles to take. Let's do a very quick case scenario. I think it will help us understand why we have focused on different areas in Yoma Bank, which will be explained by Paul and Samantha in a minute. So please imagine an SME customer in Myanmar. When they are coming to the banks, they usually have no documentation. They are thin paper clients. Let's face it, they are no paper clients. They have no records, they have no balance sheets, they have no documentation at all. And then please imagine, how would you react as a bank? Of course, you would ask for super high collateral. And the problem is also regulation would support you, because uncollateralized lending was only allowed a few months ago, and only to some extent. Therefore, you will not find an established culture of risk assessment or risk-taking in the banks in Myanmar. And then we also have a problem with the central bank. It sets interest rate caps for loans. There is no incentive for banks to properly assess credit risk, because a risk-adjusted pricing is simply not possible. And last but not least, we could, of course, think about leveraging other institutions of the financial ecosystem to gain data insights about SMEs. But also there, Myanmar is not ready yet. The credit bureau is not operative. You see, there are some challenges in the financial ecosystem for SMEs and for banks, which needs to be fixed to improve access to finance for SMEs in Myanmar. But, and that is crucial for the presentation you're hearing today, that is sometimes not possible, and then we need to organize a workaround. So Paul and Samantha, how are we organizing that workaround in Yoma Bank in Myanmar?
Okay, so this is Samantha. I'm a head of a SME of Yoma Bank. Let me talk to you a bit about our Yoma Bank and a local market condition. Yoma Bank was founded 25 years ago, but it lost its license for 10 years and then getting the license back in 2013. However, it has grown from the rank of 18th to 4th biggest bank after getting the license back. So we can say that it was an amazing recovery in just under 6 years. Yoma Bank has 81 branches across the country, while the other largest bank has somewhere around 500 branches. Yoma, we do not have ATM, but we rather pay to use other ATMs established by the other banks. So the bank has currently 4,500 of SME customer with a total loan portfolio about $1 billion. So I'll mention a bit about the Central Bank of Myanmar. So currently, Central Bank of Myanmar restricted all the banks to only grant secure loan against real estate. So interest rate are also capped for the loan and deposit. That's why risk-based pricing was not possible, and all the SMEs and corporate being charged pretty much the same rate. So and some Myanmar banks have traditionally offered overdraft, not only with the monthly repayment of interest, and principal is on a maturity of the loan tenure. Some interest payment of overdraft and loan were made quarterly, which complicate the definition and reporting of non-performing loans. Recently, Central Bank has implemented a regulation where banks should have a certain percentage of overdraft versus the entire portfolio in 3-year time frame. Besides, the regulation also requires customers to repay their overdraft to zero for at least 2 weeks of the year. So way before the regulation of the central bank, Yoma Bank has its own strategy. That is, customer can receive loans that is structured 50% term loan and 50% overdraft. Thus, we are already in compliance with this new regulation, and by virtue, the NPL ratio of Yoma Bank is the lowest in the market. So let us now focus on the SME lending initiative with the help of the GIZ. It was always foreseen by Yoma Bank management that a more of a liberalized lending environment would only be a matter of time. With the support of the GIZ, we started talking our existing customer about their challenges and their needs. That is often what lender needs. So as in the market, SMEs are under capitalized and only have so much real estate that they can offer to a bank. So once it is exhausted, the opportunity to learn is also exhausted. So that allow us to start innovating and then testing broader ideas, and then also to lend more without the pleasure of the real estate or even completely insecure. But the bank, Yoma, wanted to reinvent its existing secure lending product and process and then procedure. So let me explain a little history about Yoma Bank secure lending product and then the few problems that we set out to solve. So before the core banking systems and reinventing all the loans product and process, each branch will ask for different information, require different documents from the client, and also manage the application in their own way. So that works well until the banks grew and then wanted to learn more. So it was a lengthy process, and those delays became the norms, and then tense kind of frictions between the branches, head office, and the customer. So to write more loans in this matter, we will need more headcounts. That means it will increase the cost while the interest rate remain the same. So with the help of the GIZ, we set out our journey to reboot our SME business. So what we have done is we have tidied up all the process and procedure. That means customer loan requests, regardless of what branch they apply in, will be processed in the same manner, require some supporting document and information, and will be processed and approved in the same amount of time. So the SME Express loan was born, and SME support team was established to act as a control point for all incoming loans, and we ensure that all information required was correctly compiled and validated prior to the final underwriting. So we are now able to monitor every step of the process and the time it takes. So over the last 3 months, we have reduced the approval times from over a month to an average 5 days. At best, we can process and approve in 2.5 days. From that, Yoma Bank Express Loan was born, and then it was like 300 increase the number of smaller loans being processed and approved, evidence that the bank can now manage a smaller loans and reach more customer. So the SME Express loan forms the foundation of SME products. So there is a field sales force, and then I want to explain you how we organize those sales force. We call them as the SME specialists. So dedicated SME specialists have been tested and selected to be in place in the branches. As mentioned before, relationship is key to the customer, even more in the small regions, regional towns outside of the city. So SME specialists have loan and performance target, and the loans they submit are also the measure for quality of their submissions. Banks we find it a bit struggles because we are experiencing daily noise from the walk-in customer, transactional banking, and other day-to-day tasks. We constantly look to remove all the noises, but it takes time. So a team called centralized sales team called SME handlers has been established in head office. So we will also have another team in Mandalay too. So they are not tied to a branch, but rather a region. So as they do not sit in the branches, they can focus 100% on a business development, and then also acquiring more business for a bank. So it was a great success. We started with 10 handlers. Now we are trying to expand it to the 15 in Yangon. Currently, they write on average 5 to 6 million USD per month, which is about 4 to 5 times what 10 branches can produce. We have really appreciated the banking training that delivered by Frankfurt School of Banking through the Yangon University that allows all the SME related staff to become a first-in-class SME bankers. So Paul will continue with how we digitize our SME offering.
Okay, thank you, Andy, and thank you, Samantha. So now I'm going to talk a little bit about how we've digitized our SME offering. So it should be considered in most markets, not just emerging, that the bank's human relationship with SMEs is very important. So people buy people, and people need to trust their bank. Digital can then augment this through being able to offer smarter products, which improve client convenience and satisfaction. Bankers often forget what it takes to run a small business. A business person does not create a business so that they can keep the best financial records possible, and they certainly don't set out to open a business so that they can submit the highest quality loan application to their bank. They set up a business as a florist as they love flowers. They set up a vehicle repair business as they love cars. They open a restaurant because they love food. So as bankers, it is our job to make our products and services as smooth as possible for the SME business owner, and also appreciate that they are not qualified accountants. So our first problem, which has been touched on already, is frankly the lack of information and data that exists in the marketplace. Credit bureaus are typically the prime source of data when assessing a loan client, complemented with financial and, of course, a management assessment, or the well-known 5C principle of lending, all of which are difficult in a Myanmar context. No credit bureau, highly informal market where cash really is king. So we set out to find ways that we could consistently rate or score our clients and get a better understanding of their business revenue and profitability. As no data is available, it was not possible to construct a traditional scorecard, and rather we had to set out creating an expert scorecard. So how did we do this? Well, what better way to do this than call in all the experts that we had in-house in Yoma, and we created a project team from the bank and started to assess what we believed were the qualities that make a good loan and what questions could be asked to collect this information. So our experts, which came from risk department, sales, branches, audit, came up with 50 or so questions. This was then cut down to what we considered were the top 26 questions. And then points and weights were then allocated to each question, and a qualitative credit assessment, otherwise known as QCA, was established. We commenced running new loans through the QCA in parallel to existing approval process. And we also started to backtest the problem loans and loss loans to check if the QCA could detect these problematical loans. The initial results indicated that our expert scorecard carried a Gini of 60. So a Gini of 100 being the best, and actually also technically impossible to have a scorecard that has a 100% success rate. Nevertheless, 60 was extremely good, and I think a reflection of the experts that we used in compiling the questions. Nevertheless, we found some of the questions did not function well in practice. It didn't really have much influence on the overall score, and were deleted. So this is all very nice, but why is this digital? I can hear you thinking. So the QCA is a tool that arguments our current human-reliant process. Field officers will now be given a tablet with the QCA tool loaded. So whilst visiting the business, field staff will be able to run the customer through these 26 questions and in real time receive a decision in principle broken down into 3 traffic light categories. So red, amber, and green. Each category is self-explanatory. So obviously a green, they've scored very high. It looks like a good case. And a red, it doesn't really look like a good SME for one reason or another. Simultaneously, this data is sent to head office where it is analysed in more depth and also stored in a database for future reference. So until recently, the amount of data also that the bank had was not great. So also part of this journey was to create this depository of data for future use. So as I said, if the QCA indicates a green or amber, then the field officer will carry on with the financial analysis of the business. If the field officer thinks the request has merits, yet it was rated as a red, the case can still be continued, but will receive a higher level of analysis by the support team. As the QCA is calibrated and the score becomes more reliable, red cases will not be accepted, or rather we will find we can calibrate the scores so we don't get so many reds. So a whole calibration process will continue. So the QCA really goes a long way to make the loan application process much easier for the customer and our bank colleagues. So historically, we were collecting lots and lots of documents to basically justify why the SME was a good risk. As Samantha touched on, we are asking all the clients the same information, and now statistically, we can now rate the clients. So we can statistically say this SME is better than this SME, etc., etc. Something that we couldn't do in the past. However, the bank's next biggest problem was informality in the market. In Myanmar, cash really is king, and SMEs do not really prioritize keeping really detailed accounting records. So-called accountant-prepared or audited financial statements are available. However, the quality has proven to be extremely poor in terms of accuracy, and also there's a big trend of underreporting, which to be fair is common all over the world and is not really a unique thing to Myanmar. Most SMEs in Myanmar will transact together in cash, with a small but growing percentage transacting through bank accounts. However, the SMEs using bank accounts tend to be more sophisticated and by virtue larger in size, so only a relatively small percentage of the market. In more developed markets, SMEs can access accounting software like Xero, etc., which allows an SME to record their revenue and their costs and produces for them a profit and loss statement and a balance sheet. In the Myanmar context, this is completely unheard of. In the main, SMEs keep paper-based records, so imagine piles of what we call voucher books where they record the sales, which the SME field officer then needs to attempt to reconcile. So a job that, to be frank, an experienced bookkeeper or accountant would probably struggle with, let alone a bank official. So I think you're beginning to get a flavour that the financial assessment is extremely difficult. So therefore we started looking for a low-cost, simple software that we could deploy with our customers. We found Q. Q is an Asian-based company active in several of Myanmar's neighbouring countries, and offers a simple accounting package for micros and SME businesses. Yoma Bank entered into a contract with Q to tailor this software to the needs of our clients, and over the last 6 months we've been quietly testing this with a number of SMEs. The software is also a tool that will help financial literacy. So we have simplified the UX and UI, so it's very easy for a businessman to understand. And by using it, they will get to understand more about their revenue, more about their costs, more about their profit, etc., etc. Andy touched on earlier that Myanmar is really ahead in terms of, let's say, technology and connectivity. And therefore, we really believe there's an opportunity for Yoma to leapfrog the traditional methods of financial validation by using this accounting software to make life easier for the clients and bank colleagues. The bank will now begin to roll this software out to all its SME customers. So as Samantha mentioned, that's some 4,500. If SME customers can be convinced to use the software properly, it will allow the bank to further digitize its loan approval process, removing the need for lengthy financial profit and loss reconstruction and validation. Field staff rather will be required to cross-check and spot-check certain data to ensure the reliability. They will not have to reconstruct profit and loss statements and balance sheets, in turn reducing the amount of underwriting time used to approve such a loan and significantly accelerating the time it will take to approve the loan. And I think it's fair to say we look forward to reporting positive progress on this in hopefully a future webinar. So whilst all this digital work goes on, the bank still needs to do business. So in anticipation of the central bank relaxing regulations towards unsecured lending, and to follow the bank's desired strategy to lend more without relying upon collateral, GIZ and our colleagues inside Yoma in the SME team set out to innovate how we could grant such loans, but loans that could be originated without creating an army of field agents and underwriters. So bear in mind, due to the banking infrastructure issues mentioned earlier, it was decided to focus on two areas. These two areas we felt we could validate safely. So the amount of transactions an SME does through a bank account. So I would caveat that because I've already mentioned only the most sophisticated and larger SMEs use bank accounts. Nevertheless, there is a population of these businesses. And also we started to look at who an SME does business with, and why, and what alternative cash flow data and proxies we could possibly collect from these partnerships. We still use what I would call legacy lending best practices, such as clearly defined loan purpose, controlling the disbursement, and a controlled collection of the revenue being generated by that business to secure our risk. So we are in a highly informal market where we cannot rely on financials. So really these legacy belt and braces, if you like, lending practices really can help secure our risk. So till now, no bank has been offering any unsecured lending, and these initiatives still today are very, very new to the market. So let me explain a few of the initiatives that we've undertaken. So using cash flow, I think our first initiative was Wave Loans. Wave Money is a subsidiary of Yoma Bank and Telenor. Wave Money is very much like M-Pesa, which I think most of you you'll be familiar of. So it's a remittance and wallet-based provider of financial services. And currently it has some 40,000 agents all across Myanmar, providing the traditional remittance cash in and cash out and other payment products which are growing daily. The agents, as with most mobile money companies, are managed by master agents who are typically SME businesses with several other activities. Master agents are responsible for recruiting agents and in turn receive a share of the commission for all transactions going through their agent network. Wave Money was growing extremely fast, 30% month on month, which meant that agents needed to maintain an additional 30% of Wave float month on month. So 30% not being a small amount of money, this was growing rapidly, and for the smaller agent, it was beginning to hurt. The float that needs to be maintained for Wave is always competing against the purchase of other products like soft drinks, vegetables, other staple food products that the small agent could sell through their shop and make money. So obviously the agent chooses what it can sell probably the fastest and what it can get the highest margin on. So therefore, to alleviate this pressure, we designed a loan program using the data available from Wave to establish an unsecured working capital facility for master agents. We based this facility basically on 1.5 days transaction value that we were seeing through the network for that master agent. And we put a cap of circa $50,000 on that facility. So an agent would qualify for 1.5 days of his working capital towards Wave, or 50,000 US. This liquidity was then placed into the agent network by the master agent using Yoma Bank's digital banking app, which is called the Smart Account. So this money would move digitally. There was no cash being moved, floats were being topped up electronically through the Smart app. So, as I said earlier, we're now controlling the disbursement. We know where the loan is going. Samantha touched on earlier that most Myanmar banks would grant overdrafts to clients. The overdraft would be drawn and it would stay drawn for 365 days of the year. So, on the Wave facility, we set the condition that it had to return to credit every 60 days, needs to return to zero for 1 or 2 days, then the master agent can redraw the funds. So this is how we were controlling the repayments. Alongside this, the bank's retail digital team, using the same principles, offered nano and micro loans direct to the Wave agents themselves. So we kind of hit this from both angles, one from the master agent, and we also provided additional liquidity directly to the agents at the bottom of the pyramid. I believe currently in total some 4,000 unsecured loans have been granted to SMEs across Myanmar without the need for bureaucratic documents and collateral. To date, non-performing loans are zero, as failure to repay jeopardizes the SME's relationship with Wave Money. And we have to remember, Wave Money helps them make money. So really to default towards Yoma would be a little bit foolish. And this is proven with NPLs currently at zero. This product will shortly be launched for another mobile network operator's agent network, meaning Yoma Bank will now potentially reach an additional 100,000 SMEs with unsecured finance, all based on alternative data of the partner. So Wave Money, and in the next case from the mobile network operator itself. The next product we have been working on is what we call the transactor product. So due to issues with validating the revenue of the business, it was decided to consider the volume of transactions going through the accounts of a Yoma customer's bank account, and also accounts held by the same customer at other banks. Samantha touched on that we are the fourth or fifth bank by market size, and above us there are three large banks where typically most SMEs will have a transactional relationship with. Whilst this is not a true reflection of revenue, it can be considered as a measure of cash flow being circulated through those bank accounts. However, to do such an analysis, a significant amount of manual checking would need to have been undertaken. And to this end, with some innovative coding and data science from our MIS colleagues, it has been possible to extract the necessary data from the bank's core system. Using that data, we can now produce automated reports and see what kind of flows are going through our customers' bank accounts, the average balance, the debit balances, the credit balances, etc., etc. Currently, we're working on an OCR reader that can read the bank statements of other banks and also translate this information into a report that allows the bank to quickly assess the cash flow circulating and what level of facility we will be able to grant the customer. One important factor is the facility we describe actually as undersecured, and it complements the secured express loan product that Samantha presented earlier. So typically with the express loan, a borrower can get 70% of the collateral value. The transactor now allows us to go up to 100% of the market value, based on the transactions that we see. And to maintain this facility, the SME needs to keep transacting through their bank account. So this really was our first step into undersecured, where we were safely pushing up the lending limits to 100%. It's probably a little bit early, but the NPLs and the performance of the facility really so far is very clean. So it seems to be working well. Supply chain finance is another one of our initiatives, and this involves lending to the suppliers or buyers of a large corporate, or what we call an anchor. The anchor allows the bank to have better information on the behavior of that supplier or buyer. It provides us the alternative and very rich data that otherwise we wouldn't be able to access. Because we're working with an anchor, it also gives us a clear loan purpose and also a very clear repayment source. So Yoma set out to capitalize on some of its corporate relationships and to also target large corporates that it did not perhaps have a relationship with, but we knew those corporates had very large bases of suppliers or buyers. We really wanted to have mass reach, and partnering with such large anchors was really a way to achieve this goal. So we've developed a product that kind of works on both sides of the balance sheet, so account payables and account receivables. Account payable, this uses the purchasing behavior of the anchor's buyer. From this, we can calculate a credit limit towards that buyer. This historical buying data serves as a proxy for affordability and cash flow, and also the revenue of the business. And as the facility is used to buy more products or goods from the anchor, we are controlling the disbursement, meaning the money cannot be used for other purposes. So again, you will see all the way through this the theme of, let's say, the traditional kind of 5 C's of lending. So, for example, the buyer buys the products, which they will then sell, converting them into cash. This cash is then used to repay our facility. So we have a nice closed loop. To enable this product to scale without the need for the client to keep visiting one of our branches, we digitize the process, developing a simple app through which the borrower can forward the pre-order from which the bank centrally checks that the borrower then has the availability of funds under the credit line and notifies the supplier that the payment will be made on delivery of the goods. So in simple terms, that means we've given our customer an app. When he makes the pre-order or when he gets the purchase invoice, he forwards that document to us electronically. It comes down a pipe. We check they have room under their pre-approved limit, and then we disperse the funds to that anchor client. So they do not need to go to the branch until the moment that they need to repay the facility. Following a number of successful cycles, meaning they've drawn on the facility and they've repaid the facility, a buyer will receive an increased credit line from the bank that they can then use for other working capital purposes. So using the data from the anchor generally is supplying a handful of products to the customer, which is only a small percentage of their overall business. We've leveraged this data to enable us to be able to lend more for other purposes. Account receivables. Using the same data as before, we have financed the account receivables of the suppliers to currently the largest supermarket group in Myanmar. The supermarket group have been trading for 20 years and they have a base of some 1,500 typical SMEs supplying everything from local Myanmar produced agri products through to your day-to-day products, milk, eggs, etc. We first attempted to finance the short-term receivables of these suppliers, but we quickly learnt that there was no demand for this. Suppliers, whilst getting paid every 45 to 60 days, are delivering sometimes daily. So after the initial credit period, they're also getting paid daily too. So it wasn't very compelling to finance those invoices because the durations were too short. We went back to this group of customers, we went back to the supermarket group and proposed that we rather provide finance based on a larger amount. So to this end, we redesigned the product to advance the borrower several months' sales in the terms, several months' revenue, which would then be converted into a loan product. So let's imagine our customer is supplying the supermarket group with 30 million one month, 30 million the next, 30 million the following month. That's 90 million. So we granted a 90 million chat loan. The first 6 months interest only. From month 7 to 18 is capital and interest, finally returning to zero in the final month. So this allowed for the SME to receive a loan. We capped it at 300 million. So 200,000 US plus minus, which is a meaningful amount. It's completely unsecured, and the only condition we had is that the money was used to uplift their business. So they typically would invest in vehicles, in more machinery, maybe a different product line, etc. A key condition of the scheme was that the supermarket group makes all those invoice payments directly to the customer's account at Yoma Bank. Thus, we could capture the revenue and we can immediately take our loan repayments. So I know time is short, and this pretty much sums up what Yoma Bank has been doing, let's say, in the traditional field of tidying up process, making things more efficiently, and our first steps into digitizing our loan products. So on that note, I'll hand it over to Andreas to sum up, and then we can open up to any questions that anyone may have.
So thank you very much, Paul and Samantha, for that overview. It's really impressive to see what kind of achievements we have with the Yoma Bank and the progress of the bank in general. So in the teaser of the webinar, we promised also to talk a bit about regulation, because we believe that regulatory approaches and digital solutions belong together. So let's focus on the regulatory side for a few minutes. You see the cartoon. We believe it always be a challenge to strike the right balance between regulation and deregulation. And from our perspective, two elements are really important. An enabling environment for digital finance requires a data flow environment. You know, we usually speak about data protection, but let's face it, data needs to flow in our digital world. We are not against data protection, no doubt, but we need to make sure that it's not too burdensome to access alternative data from customers and work with it. And of course, this can all happen with the consent of the customer. I am guessing now, but I could imagine that in most of our countries we work with, data protection is rather too weak than too burdensome for digital financial solutions. A liberalized interest rate environment is a second major requirement for successfully deploying digital financial solutions. Not everybody is going to love what I'm going to say now. Alternative data analysis make it possible to really serve SMEs and hopefully also micro SMEs. So far so good. But it comes with a higher risk, and the digital financial service providers need to charge a higher premium for higher risk. That's also part of the story of financial inclusion. The next slide represents some regulatory areas which are key to enable a supportive digital financial environment. The exclamation mark indicates that we are talking about core parts of banking regulation. For example, know your customer, anti-money laundering, counter-terrorism financing, remote account opening rules, or rules for interoperability. But we should also have a look into these areas when we are working on the development of digital finance solutions. But also other areas need our attention, like national ID systems, consumer protection, competition policies. I'm not going to talk in detail about policy principles in every field because of the simple reason that I, of course, do not know every field. But if you wish to exchange about one or the other, please send us a message and we are more than happy to discuss. So, based on our experiences we have gained during the project, we have prepared some insights or very dull assumptions. You decide, and we are more than happy to discuss. What we did in Yoma Bank was basically creating tools for things which are around in developed economies. That's why we conclude digital finance is mainly a tool to circumvent missing but essential parts of a financial ecosystem. And in the absence of traditional financials, we also believe assessing alternative data will be a core competency of banks, especially in developing economies. Digital SME finance is highly automated. Therefore, building capacities for assessing credit risk in certain sectors is going to be less important in the future. We have seen the average loan sizes going down significantly due to the usage of digital financial tools, also in Myanmar. That's why we believe digital finance offers banks the opportunity to really serve the SMEs and maybe also the micro SMEs. And the last one, we figured there's often a misinterpretation. Cash flow-based finance is a tool to assess credit risk, but not to replace collateral. And with that, we leave it for today, and we are more than happy to discuss with you your ideas and your thoughts about that in the future.